You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello and welcome to The Investor Way with me, Sam Ball. I'm joined today by my co-host John McEwen, and it's the 17th of August 2023. In this week's episode, we'll be discussing Ibstock, Entain, McBride, TUI, Coca-Cola Hellenic Bottling Company, and our US company of the week is Disney. John, should I start us off with Ibstock?
Go for it.
So, Ibstock, company we have covered multiple times before, but for anyone who's not aware, they are the UK's largest brick maker. They have come out with their half-year results, and half-year revenue fell by 14% to 223 million. This reflects lower sales volumes, especially in residential, which was partially offset by higher prices. Underlying cash profit, EBITDA, fell 11% to 63 million, driven by the lower sales volumes. Underlying free cash flow fell from a £30 million inflow to a £22 million outflow due to investment in new brick plants and other growth projects. Net debt rose by 53 million to 89 million. Ibstock continues to expect a performance in line with market expectations, and analysts are forecasting full-year revenues of 487 million. The interim dividend was raised 3% to 3.4p a share. Cost inflation is starting to show signs of cooling. However, it is going to remain an issue for the rest of the year. And although Ibstock is the largest brick producer by capacity in the UK, they are looking to increase further with the modernisation of two of their factories, and the upgrades are expected to be completed by the end of this year, which should lower production costs and allow the group to meet higher demand as it arises. There's also been quite a lot of effort to become a leader in more sustainable house building with the advent of a new division, Ibstock Futures. The first area that this segment are going into is brick slips, a type of lightweight brick facade. The group's invested heavily to build the UK's first brick slip factory, which is expected to come online by the end of the year. The division also added a glass-reinforced concrete business to its portfolio in 2022, as well as a fireproof cladding company, and that is to further progress the sustainable strategy. In terms of valuation, the business trades at a forward price-to-earnings ratio of 10.4, and that compares to an average since listing in 2015 of 12.3. The prospective yield in the next 12 months is 5.7%, and that compares to an average of 4.5% since listing. I think these results, not great, but it was to be expected given what we've seen from the house builders, and they are very heavily linked to industries. It's a very cyclical business. I think that's reflected by the facts that, well, it's reflected by the valuation, I think. It's a business I've owned in the past. I wouldn't be against owning it in the future, but I would have to consider whether I'd want a house builder instead, given they are pretty similar and the fortunes will probably rise and fall with each other. Although I think you do have a little bit more protection with Ibstock. In terms of the share price, the shares are down 23% in the past year and down 37% in the past 5 years. And with it already being the largest by capacity, yes, I know they're trying to expand into slightly different areas, but one of the reasons I sold it was you look at it and I just felt, where does the growth actually come from? Because I don't think any of these new areas are going to significantly change the revenue. So really, it is just a bit of a cyclical, really, which is why I sold it in the end. John, what are your thoughts on these results and the valuation?
Similarly, I mean, I don't think they're terrible results where we are in the cycle, and I think it's really reflected in the valuation. The shares are really cheap. They've got a decent dividend yield, although of course that's not guaranteed. I have a house builder, and I don't think I'd really be looking for more exposure at the moment. But I do think it does have long-term tailwinds in that we have a shortage of houses in the UK. They need to be built, and it's expensive to import bricks. Ibstock is the biggest producer, so I think there is a lot going for it. It's not going to shoot the lights out even in the long term, but I think it's a chugger really in terms of a company which I think long term going in the right direction, and it's fairly priced, but it's going to be a bit bumpy for the next couple of years or foreseeable. I suppose it's not impossible that there'll be more stimulus to the market if you do have a new government and they have some new sort of house building policy. But it's not a stock I get too excited about, but one that you might sort of have as something fairly solid in the portfolio for the longer term.
Right, shall we move on to what probably is a slightly more exciting stock?
Yes, so Entain, literally exciting that it's a gaming company. They had their first half results out last week with first half net gaming revenue of £2.4 billion, excluding BetMGM, which is the joint US venture, which reflected growth ignoring currency moves of 11%. Excluding new acquisitions, organic growth was 3%. And online net gaming revenue saw organic growth of 1%, but affordability measures in the UK and a tricky German market weighed in on performance. In the retail business, organic growth was 8%, supported by good trading in the UK and in Italy. BetMGM saw net gaming revenue up 55%, with Entain's share of losses narrowing from £108.6 million to £48.5 million. The business reached a milestone and delivered a positive cash profit EBITDA over the second quarter. The group has set aside £585 million in preparation for the resolution of HMRC's investigation into bribery at the legacy Turkish business. Excluding that charge and other one-off items, underlying operating profit rose 25% to £307.4 million, largely as a result of lower losses from BetMGM. The period ended with net debt, including leases, of £2.6 billion, and Entain generated £231 million of free cash flow. The board proposed a dividend of 8.9p, which is up 5%. In terms of valuation, Entain has a market cap of nearly £7.5 billion and trades at 18 times forward earnings. I thought these results were okay. Obviously not ideal with the Turkish situation, but as always, when we cover Entain, it's the BetMGM joint venture that's the really exciting part of the business with the potential for huge growth ahead of it. And they're expecting it to be fully profitable in 2024. And compared with its 10-year average, if we're looking at valuation of 13.5, it is expensive at 18 times forward earnings. But really, I think it's taking into account that growth potential. So overall, results fairly average, but I think still you're getting massive growth or revenue growth, at least in the BetMGM, which is all going in the right direction. And that's something that you're not getting with other gaming and sort of bookmakers back in the UK. So I suppose that is the investment case for it. I think it's an industry that I wouldn't invest in more ethically. So not one for me, but I think valuation wise, it's pretty fairly valued considering that potential growth ahead of it. Sam, what are your thoughts on these results and Entain?
I think the results, similar to you, are pretty all right. The main figure I look at is the US revenue, which was up 55%. So that's the main figure I would be judging it on. I think there's quite a lot of debt, but if the US business does as well as you'd hope it would if you were a shareholder, I wouldn't expect it to be an issue. So yeah, a bit pricier than historically, but it didn't historically have a US business. So I think really the whole valuation just hinges on whether or not you think the US business is going to be a success in the long term. If you do, I think it's pretty cheap. If you don't, it's probably quite expensive. So yeah, not really a huge amount more to add because the main thing I do focus on is just that US figure. The rest of it, I can sort of take it or leave it. I would never invest for ethical reasons. I just don't like the business, but it is interesting at the moment.
Yeah, and I think the share price is down by about 30% over the last year, which again is interesting. But it's, yeah, those numbers from the US, they're still putting them up.
Right, should we move on to another business then? Don't really have much to introduce it with because no one's ever going to have heard of it.
Yeah, go for it. It's a listener request, I believe.
It is a listener request. With you in mind, John, actually.
Oh,
A listener that's well aware of your love of consumer goods.
Okay.
So they have requested us to look at McBride, and I'm assuming you haven't heard of McBride, because I certainly haven't.
no.
McBride is the leading European manufacturer of cleaning products for the domestic, household, and professional cleaning and hygiene markets. With trading roots dating back to 1927, they employ 3,400 people across 18 locations in 12 countries and sell over 1 billion products each year. They develop, manufacture, and distribute products for both private label clients in the retail segment and contract manufacturing for established brands. Their teams are among the best in the industry and apply their expertise across 5 focused divisions, which are liquids, unit dosing, powders, aerosols, and Asia Pacific. In terms of the brands, the core business is private label, but they also have a growing portfolio of their own brands in the household category, and that includes Surcare, Oven Pride, Clean and Fresh, Hospec, and Active. They don't actually have any results out. I think they have some results that are about to come out, but as we're covering it for the first time, just to get a flavour of the business, I've looked at the last results that have come out, and they are the results to 31 December, and these came out at the basically end of February, start of March. So these are pretty old results, but this is just to get a flavour of the business. So in the last set of results, private label volume grew 2.6%, which was an increase of market share. First half revenues were up 102.9 million, which was higher by 30.3% at constant currency, mostly from price rises. And they have a program Compass, which is on track to deliver £20 million of annualised savings. The net debt is steady at 169.4 million, which I thought was high given the historic performance. So historically, the operating profit has been, year to June 2018, 32 million, 27 the year after, 15.5 the year after, 15.5 the year after, and then a £26 million loss the year after that. So I think net debt of 170 million, when the best operating profit was 31 million 5 years ago, that's pretty high. That's over 5x. So that is at a level where I would not be comfortable with it. In terms of the results, the operating loss improved from 14.7 million last year to 2.6 million this year. Adjusted diluted loss per share improved from negative 8.1p to negative 4.2p. And the adjusted return on capital employed decreased from negative 4.6 to negative 5.5%. And in the slides, they've highlighted that their key customers include Aldi, Lidl, and Tesco in the UK, and then they've got quite a lot of foreign ones, actually. So they've got Kaufland, DM, Carrefour, Intermarché, Netto, Edeka, Leclerc. I've butchered the pronunciations on every single one of these. Eurospin. But yeah, by geography, 22.3% of their revenue is Germany, 21.9% is UK, 20.7% is France, 8.5% is Italy, 3.7% is Spain, 3.1% is Asia Pacific, and rest of the world is 19.8%. So they're quite nicely geographically diversified. Sales overview by channel, 84.5% of the sales come from the private label brands, 10% are from contract manufacturing, 3.5% of the McBride brands, and 2% professional. And for their divisions, 55.8% of revenue comes from liquids, 26.1% from unit dosing, 10% powders, 5% aerosols, and 3.1% Asia Pacific. They've highlighted that 77% of their revenue comes from top 5 European economies. In terms of the valuation, there's no PE because they're currently loss-making, and the market cap is currently £67 million, but that is with a lot of debt. What does look quite interesting is, although the market cap is 67 million, I don't know if the business has changed, but they had an operating profit in 2021 of 15 million. And profit after tax was 14 million. Profit after tax in 2018 was 19 million. That was on the operating profit of 31 million. So if you think you can get back to that, it's at 4 or 5 times what you might consider normalized earnings. So it is pretty cheap, but it is a turnaround. my view from the initial look is, although it's consumer goods, I don't find the brands particularly inspiring. I think to do what it does, it basically has to be like the lowest cost operator. And that's a business model that I generally try and stay away from. I also don't particularly like turnarounds because I'm not very good at picking them. So my track record also suggests I should stay away from it. And there's just not really much in those brands that inspires me if I compare it to like Unilever's or Nestle's brands. And I appreciate they're much more expensive, but it's just not a business I would want to own. It's a very competitive industry. So yeah, that would be my biggest concern with it. So for me, it's fairly interesting, but I wouldn't probably take another look at it. That's more to do with the industry and the brands. If it had a few more brands I recognised, maybe there's a valuation I'd consider it at, but I don't really know any of the brands, and there's no brands that jump out at me as particularly strong. John, what are your thoughts on the results and the business?
Yeah, I mean, the results, they're obviously improving after having a difficult time, and impressive revenue growth. I appreciate they're not, yet back to profitability. I think the main reason that I wouldn't invest is similarly, I like a company that has very strong brands, and I appreciate they've shown some pricing power, but it's nothing like what you've got with your sort of Unilevers and your Nestle's. And I wouldn't argue even like Reckitt. And Reckitt, whilst it's a much, much bigger company, is more similar in terms of the portfolio of brands with the sort of domestic household, cleaning, hygiene. And even then with sort of Reckitt, it's a stock I'm considering selling because I don't think they're as strong and they aren't able to hike the prices accordingly as much. And we saw when we covered Reckitt recently that they're dropping off the volumes a lot as a result. The debt is also a concern. And this kind of bottom end of the market, without those strong brands, I would have concerns. I appreciate it's not priced up, like a Reckitt, a Unilever, an Nestle, but still, I think I'd rather just pay up for the quality, essentially. So yeah, it wouldn't be one for me, but I think it'll be interesting to cover it on the show and come back and, could prove us both wrong.
Right, shall we move on to a business that I don't think will prove us both wrong?
Okay, yes. So TUI, we have covered it before. It's the travel group. They had their third quarter results out, with third quarter revenue rising 20% to 5.3 billion euros, ignoring the impact of exchange rates. This was helped by improved volumes of customers as well as higher prices. Underlying operating profit landed in at 170.7 million euros, up from a loss of 27 million euros last year. The improved performance was mainly driven by the cruises and markets and airlines divisions, which both benefited from improved demand. Net debt improved from 3.3 billion euros to 2.2 billion euros, helped by the equity raise earlier in the year. Free cash flow over the first 9 months fell from 1.7 to 0.7 billion euros. And TUI says that they continue to expect underlying EBITDA for the full year to increase significantly, reflecting the recent momentum seen in bookings. Shares were up about 2% after the results. In terms of the valuation, TUI has a market cap of £2.7 billion and trades at a forward price to book of 1.6, compared with a 10-year average of 3.6. The shares are down 96% in the last 5 years and 82% over the last 2 years. I mean, clearly it's positive that TUI are now making a profit again, which was largely driven by the improvement in the cruises and the markets and airlines division. But the group does have a lot of debt even after the equity raise, and we're in a cost of living crisis. So buying something that's very discretionary with the holidays and the travel, I would be wary of. And also, I think in the last decade or so, the industry has become so commoditized with the rise of the online travel agent, which makes the sorts of holidays that and flights, etc., that companies like TUI offer pretty much redundant. You've seen a lot of the other travel agents go bust over the last decade, And I would question what the future is for TUI. You might argue that there's some value or it's a sort of turnaround, but I would just, again, I'd still stay well clear of it. And I know, sort of anecdotally, what I would do, it would kind of be Skyscanner, Trivago. That would be, and I think that seems to be how a lot of people are operating their holidays. Perhaps if they wanted a much more, if they want to customize it more, go on more of a specialist holiday, they might look at Trail Finders, something like that that's slightly more premium. But at the sort of the end that TUI's operating, I just don't think people need have a need for it anymore, and they can get, as a result, get better prices elsewhere. But in a race to the bottom really is how I see the industry. So yeah, it's not one that I would go for, and that's of course not to mention that the difficulties that they've had, or that everybody has had in the travel sector over the last few years with the pandemic.
I'd agree with you. I think these results are actually better, but the issue is, even at the best of times, it's not a business I would want to buy. Isn't in any industries that I would consider to be attractive. The debt position is a little bit better, but that's because they've done an equity raise. So they've diluted the existing shareholders, which is partly why the returns are so poor, although there's many factors why the returns have been poor for shareholders. But yeah, even with the equity raise, it's not really a business I'd want. We could look at this business in 3 months' time, and if that debt were entirely gone, I still wouldn't be interested in it. It's just in such a difficult industry. I think it's facing so many long-term headwinds that I just do not see a scenario where I'd ever want to buy it. So yeah, there's not a huge amount more to say, but the results were actually all right, I thought.
Fine. Well, moving swiftly on then, Coca-Cola HBC.
Yes, so this is a business we've covered several times before. However, they've just come out with their half-year results, and alongside the results, for anyone who's not familiar with the business, they have come out with a nice little fact sheet. So I'll just run through that as a refresher for everyone of what this business is. So it's Coca-Cola Hellenic Bottling Company. It used to be the largest stock listed on the Athens Stock Exchange, but they moved to London several years ago, and we're very happy to have them. So they basically have the Coca-Cola license in, I think it's 27 countries. They are mainly emerging market countries, Eastern Europe, some Central Europe. They've got some developed Europe as well, but it's mainly developing markets. So split of their revenue is by volume. 24% is established markets, 18% developing, and 58% emerging markets. By revenue, 32% established, 19% developing, 49% emerging, and as a proportion of earnings before interest and tax, 33% established, 12% developing, and 55% emerging. In terms of the split of those, the established markets include Austria, Cyprus, Greece, Italy, Northern Ireland, Republic of Ireland, and Switzerland. The developing markets include the Czech Republic, Croatia, Estonia, Hungary, Latvia, Lithuania, Poland, Slovakia, and Slovenia. And the emerging markets include Armenia, Belarus, Bosnia and Herzegovina, Bulgaria, Egypt, Moldova, Montenegro, Nigeria, North Macedonia, Romania, Russia, Serbia, and Ukraine. They are number one in value share in sparkling beverages in 23 out of 24 measured markets. In 2022, they served a population of 740 million, and that's expected to grow 5% by 2028. Last 5 years, free cash flow was 370 million, then 443, then 497, then 601, then 645. So it's consistently been putting up impressive free cash flow numbers. I think those are the main things I think that's quite a nice summary of the business. So on to the half-year results. Organic revenue is up 17.8%, driven by organic revenue per case growth of 19%, led by the effective delivery of price and mix improvements across all categories and segments. They had organic volume growth across all their strategic priorities, with sparkling at 1.6%, energy 20.9%, coffee 21.9%, and stills declined 11.2%, led by water. Overall, organic volumes were down 1%. Reported revenue was up 19.3%, reflecting strong organic growth and the consolidation of Multon, which more than offset FX headwinds in Nigeria and Egypt. Organic earnings before interest and tax was up 17.7%, with margin unchanged on an organic basis at 11.2%. And per segment, for established, organic revenue was up 16.9%, led by revenue per case expansion and a resilient volume performance in key markets. Organic earnings before interest and tax grew 20.8%. In the developing segment, organic revenue was up 23.6%, driven by revenue per case expansion. Organic earnings before interest and tax was up 27.2%. And in the emerging segment, organic revenue was up 16%, despite pressure on consumer spending from macro headwinds in several markets. Organic earnings before interest and tax grew 13.9%. Comparable earnings per share was up 22.3%, led by earnings before interest and tax growth and lower net finance costs. And in the medium term, they expect annual average growth, organic revenue growth of 6 to 7% a year, and that's up from 5 to 6% previously. They've also highlighted the successful launch of Jack Daniel's and Coca-Cola in Poland, Ireland, and Hungary in Q2. They've developed the energy category in Egypt, adding the Monster brand in Q2, and they've announced an agreement to acquire Finlandia vodka from Brown-Forman for $220 million, which they describe as a unique opportunity with significant geographic overlap in CCH territories, enhancing our premium spirits credentials and driving mixability opportunities with our NARTD portfolio. Completion is expected in Q4 2023. Free cash flow was, however, down 22.9% to $256.6 million. In the slides, they've said that gross profit was up 22.6% despite 13.1% cost of goods sold per case inflation. And they've said they had strong top-line leverage and effective hedging strategy, which offset increased cost pressures and operating expenses. And they've highlighted that the dividend of €290 million that was paid in June represents a 46% payout ratio. In terms of valuation, the business trades at a PE of about 15.5, and the dividend yield is 2.89%. My view is I think these are a very good set of results. I think when you go back to the last sort of 5 years or so, it's consistently putting out very, very good results, even when you include the pandemic in the middle of it. Also, when you include the fact that 2 of its markets were Russia and Ukraine, and they've practically disappeared, it's still putting out very, very good results. I think it's a very, very good business, very well run. I like the countries it operates in, and I like the fact that you've got the comfort of the Coca-Cola brand. I know we say this every time we cover it, but it gives you a pure emerging or a very strong emerging markets play. Whereas if you go and invest in Daddy Coke in the US, only a small amount of the revenue will come from the emerging markets, which is like the licensing revenue and stuff that's paid by these guys. But yeah, very, very good brand, obviously one of the best in the world, but you've got that emerging markets focus. And it's a business that's doing a very good job as well. They are putting up the numbers, and the valuation's pretty reasonable too. John, what are your thoughts on these results and the valuation?
I mean, the more we cover it, the more I do like it. And I appreciate it is that one of the more attractive sides of owning Coca-Cola is that the potential for the growth in these sorts of markets, like you say, rather than the ones that are pretty much reliable, but, saturated. And yeah, not particularly expensive either. I was worried about, the Russian situation and how that might impact on it, but actually we've seen it's been fairly resilient. So yeah, I think it's definitely one for my watch list, and whether I'll pull the trigger at some point soon, potentially.
I do think it shows the importance as well of looking at a business multiple times, because although we have always liked the business and found it interesting, the first couple of times we started covering it in the middle of a pandemic, so it won't be putting out the best results.
Yeah.
Then we had Russia invaded the Ukraine, so 2 of its markets disappeared overnight. And here we are, we've been covering it for a couple of years now, and every challenge it's faced, it's overcome. It is a stronger business when we started covering it. Whereas we could have looked at it the first time and sort of said, well, there's this wrong, there's a pandemic, and then never looked at it again. So it does show that I think there is some benefits coming back and revisiting them. It helps that we're forced to, because we need content for the show.
Would agree with you. And also what a resilient product it is, quite apart from anything else.
It's a good brand, Coca-Cola. One to watch
Well,
out for. The
exactly.
Investaway pick of 2023.
Yeah, but no, but it's true, the defensive quality of it. And another top brand, Disney, which is our final company of the week. We've covered it many times on the show. It's a company that both Sam and I have in our own portfolios. They had their third quarter results out, with third quarter revenue coming in at $22.3 billion, up 4%, while operating income was broadly flat at $3.6 billion. And revenue growth was driven by the park segment as the Asian sites benefited from a reopening and higher ticketing prices. The traditional broadcasting weighed on both the top and bottom line as international channels moved into loss-making territory. Operating losses were better than expected in the streaming business, narrowing to $512 million, but total Disney Plus subscriber numbers disappointed, down 7.4% to 146.1 million. And that was driven by the declines in India due to the loss of the cricket rights. Better parks performance helped drive free cash flow up from $0.2 billion to $1.6 billion, and net debt was $35.7 billion at the period end. The shares were down a couple of percent in pre-market trading. In terms of valuation, Disney is massive, with a market cap of $158 billion and trades at 19 times forward earnings compared with a 10-year average of 23, and pays a dividend of 0.8%. I do recognise that Disney has a number of headwinds, and that whilst the streaming business overall is a positive, well, as far as I see it, is a positive to the company, there have been a few bumps in the road. Disappointing again with the subscriber loss and the cricket rights in India, but hopefully we'll see it profitable in 2024. And it'll also be interesting to see what they do strategically with the TV business, the ESPN and ABC in the long term. They do feel very much like last generation products in Disney's arsenal. It has been disappointing as well with some of the films, and they haven't been as successful as they might have been. However, I do still think that you've got some of the top IP in the world and an incredible park experiences business, which will drive the growth in the future. And I think combine that with a successful streaming operation, and I appreciate the growth isn't as linear as we might like it to be as shareholders, I do still think that's a wonderful combination to deliver growth into the future. So I still very much like Disney, although it's been a little bit bumpy in the last couple of years, but I think the long-term plan is the right one. It's good to see Bob Iger back and him continuing to push the business forward, even with some of the difficult decisions that he's had to make in terms of staffing around the parks business. But I remain confident and comfortable holding the shares.
I feel pretty similar. I think there's quite a bit to think about as a shareholder in these results, but nothing that gives me too much concern. It's easy to forget the revenue was actually up, despite this being a disappointing quarter. So as disappointing quarters go, it's not horrendous. My thoughts on Disney Plus is that they launched in March 2020. So in 3.5 years, they've gone from a start of 0 to whatever they're on now, 146 million. It's very, very good. I'm not too concerned about the drop, just because they were the Hotstar ones, most of them. I think it was pretty flat, the actual core ones, but the Hotstar ones, they're the ones in India that are paying absolute buttons. And I think they're good to have, because if you're giving them the same content as everyone else, it's just pure profit. And they just don't have as much disposable income to be paying the same amount as, say, the US or the UK can. So they are good to have, but equally, if you're going to lose some, those are the ones you want to lose. My view has been with the Disney Plus, just pump it out, get as many subscribers as you can, and then start upping the prices. They are starting to do that. There's talk about price increases. I think a lot of the subscribers will stay. They're cutting the costs on it. I I think very soon you get to a position where it's actually contributing cash flow rather than draining it. And then, like you've said, John, you've got all this crossover with the other parts of the business. But I've felt for a while that the amount, well, from the beginning, really, I didn't mind it because anything to get people on board, but I felt like the amount they were spending on their content was more than they needed to, just because they've got so many quality brands. I just think if you put out 2 or 3 quality Star Wars shows a year, say 10 episodes, release 1 a week, 2 or 3 quality Marvel shows, like a couple of Pixar ones, like, and then whatever else you want to pay for, plus the back catalogue, you've got enough to keep people on there all year round, especially with the movies, you know, when you've got like exclusive Pixar movies that are going straight on there and stuff. There's just a lot they can do with it. I don't think they need to spend the $20 billion a year that Netflix spends, because they've got better IP. I think they can drip feed you. Like, I will pay for it year round to basically watch 2 or 3 Star Wars shows a year. I wouldn't do that with Netflix. I don't have Netflix, but I wouldn't do that because Netflix doesn't have a single brand that is in any way comparable to Star Wars for me. So yeah, it's a disappointing quarter, but I think what we're seeing is the initial pain before the tough decisions that Iger had to make since he's come back in as CEO. I think they will eventually start bearing fruit. Yes, in 12 months' time, they might have even less subscriber numbers, but they're probably going to be profitable on them with the price increases combined with the cost decreases. So yeah, it's disappointing to see, but I think they're in a very, very good position, and they are the cheapest we've ever seen them. I wouldn't be against topping it up in the next few months. I think I topped it up back in like April, but I wouldn't be against topping it up again. It's a business that I really, really like. I think if you're willing to stick with it for a couple of tough years, you are getting it at a very, very attractive price.
Yeah, no, fair enough. I mean, I have topped up a couple of times over the last 2 years, so not a fairly decent position, but wouldn't be opposed to topping up again. Certainly very comfortable holding.
So, of the 6 businesses we've covered this week, Ibstock, Entain, McBride, TUI, Coca-Cola HBC and Disney, if you had to buy one, which one would it be? Which one do you least like as well?
I would say it would be between Disney and Coca-Cola HBC. I like them both. I do own Disney. Oh, I'd probably still go for Disney. I wouldn't be opposed to adding Coca-Cola HBC. The one I like least, it's got to be TUI.
Yeah, it's a bit of a redundant question this week. Exact same for me. TUI least favourite, Disney favourite, but Coca-Cola does look very attractive. I do really like Coca-Cola HBC. If Disney wasn't in there, Coca-Cola would have it by a landslide.
Yeah, fine. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.